Hi, I'm Jeremy Wolf, a fleet owner over in Columbus, Indiana during ACT's Market Vitals seminar. Here I'm talking with Carter Vieth, a research analyst with ACT Research. So tell me a little bit about what's going on with equipment demand right now. You just had a presentation a few minutes ago focusing a little bit on tractor demand.
Mm-hmm. Yeah, no, and thanks for the interview, Jeremy. I think everybody in this industry knows, the for-hire market, carriers are still struggling with profitability. It's been an extended downturn. This past, the second quarter of this year, the TL publicly traded carriers, their margins declined on a year-over-year basis for the 12th consecutive quarter. So in that sense, it's still ugly. No traction on spot rates, freight rates. So that is certainly, driving, weak orders, weak demand. But I think on top of that, you have, some cost increases related to tariffs, in the 3 to 5% range on equipment. You also have, sort of trade uncertainty or, this pull forward in freight and kind of, Q4 of last year, Q1 of this year, creates an air pocket later this year. And even though we see supply coming out, amongst private fleets, and while that, tightening is good, necessary to, turn a new freight cycle, I think the worry or, the risk is that, the demand side of that equation softens and sort of prolongs the downturn into 26.
So carriers aren't doing so great, demand's very low, and they're very uncertain about what's going on ahead. How are some of the equipment manufacturers and truck manufacturers reacting to this weak demand?
So at the beginning of the third quarter, on the tractor side, they cut production 20% from Q2, or maybe 25%. Maybe get those numbers right. But certainly seeing production cuts. Backlogs. Talking about weak orders. The backlogs are under pressure at sort of March 2020 levels. And if you look at inventory, inventory is a little bit better on the tractor side, relative to vocational, which is at near record levels. But certainly still elevated, historically. If you look at the inventory to retail sales, which is we like to look at, like how much. How many months of inventory is there, theoretically left to work through? And, it's like, the current inventory to retail sales ratio is at 2 months or 2.9 months, versus the kind of 2-month historical average for tractors. So what that tells us is, sales is not keeping up with builds. And, again, another function of that is just, kind of a depressed outlook, depressed profitability.
And those high inventories are just showing people aren't buying as much as a lot of dealers might have expected.
Yeah, and I think also, so inventories, shows, like people aren't buying or, build is outpacing the rate of buying. But, elevated inventories when you look ahead into, 2026, it's also sort of an impediment to higher build, it's like, well, I don't need to place an order. The equipment's there right now. So, they're kind of eliminates the need to place orders now when you can, just go to a dealer or a stock and it's there. So I think that's also part of the equation with high inventory as well, as it does sort of depress production rates.
Does ACT Research have any forecasts, predictions for what equipment availability is going to look like going forward as carriers continue to endure this freight recession?
So for this year, our full year Class 8 production forecast is 254,000 units. So that still takes us up above replacement. We sort of estimate, replacement demand for North America is 240,000 units for Class 8. So still a little bit above. I think next year, when you get into, still growing but lower economic growth, the continuation of low rates, which really kills off any pre-buy expectations ahead of EPA, NOx rules, and I think, also just sort of the uncertainty around those rules. I think there's sort of a kind of like, almost like a bifurcation in sort of sentiment. I think, the OEMs are a little more optimistic that they're, in place as they are, while fleets, after the March 12th announcement by Lee Zeldin are like, fantastic, they're gone, we don't have to worry about it. So we do have production falling below replacement next year. Sort of the fleet shrinking a little bit for the first time in maybe since like 2019, 2020. But I think part of it, is like the private fleet phenomenon that we've kind of harped on for the past couple of years. This sort of correction, would have happened in 2022, 2023, but the private fleet sort of growth, maybe delayed that, and now it's, coming home to roost now, and there's no good time for it, but we sort of delayed the inevitable for a couple years.
Okay, thank you, Carter, for talking with me today.
Yeah, thank you, Jeremy. Appreciate it.